Dividend stock investing allows me to live the good life, like Kanye West and T-Pain. There was a rap track a few years ago called The Good Life, and I really love this one because it's an upbeat track. It gets me thinking. It gets me thinking about what is ahead, the good things that are ahead. If I stay the course with my dividend investing, my dividends will pay for all of my living expenses. So I own my greatest asset, which is my time, and that therefore allows me to live the good life like Kanye West. So I'm really excited about the video today, but there is a roadblock right now for dividend investors, and it is the dreaded dividend cut. Every which way we are looking these days, it seems like dividends are being cut. And I own 46 dividend stocks, and I faced 2 dividend cuts so far with Cedar Fair and Royal Dutch Shell. I'm going to get into those today. I'm going to talk about the impact on my portfolio and how I personally navigate the difficult, tricky question of dividend cuts. And I'll share with all of you the impact that it's having on my personal cash flow. Also today, this is going to be a longer video. I'm going to go through some financial analysis on the companies that cut their dividends. I'm going to talk about Disney too. I'm going to talk about a stock that I just purchased last week, which is StarBucks. By the way, Starbucks, I love you. You allow me to live my good life. It's a simple pleasure on a day-to-day basis that I can enjoy and make each day a little bit brighter. I want to talk about OTIS today. This is an elevator company that I own that just initiated a dividend. This was a spinoff from United Technologies, so I'm really excited that they decided to initiate a dividend. I'm going to talk about my favorite premium dividend stocks of all time today. I'm going to share the list with all of you. I like to call these my ride or die stocks. I'm going to go through that in detail. And I'm going to talk today about the PEPSICO dividend increase. Even in this horrible, dreaded economy, some stocks, they're not cutting the dividend, they're raising it. And PEPSICO is a perfect example of this. So get ready, everyone. Exciting video today. Lots of ground to cover about dividend stock investing. All right, everyone. So let's start today with the topic of dividend cuts. I want to share on the screen right now a summary of my personal cash flow from dividends. And you can see here I'm comparing July 2nd of last year versus May 8th of this year. And so nearly 1 year has gone by. The reason I selected July of last year is that's when I did a major portfolio analysis and update, so it makes it easy for me to comp numbers and look at them versus that last analysis. And when I compare those dates, my dividend income, in factoring in the 2 cuts that I received from Royal Dutch Shell and Cedar Fair, and also factoring in the increases that I received, the multitude of increases from companies like PepsiCo and the Home Depot, my dividend income, it's still down. It is down 1.96%. Now, mind you, I'm not including reinvested dividends here, and I'm not including net new capital deployed. I'm looking at shares, number of shares held constant. What's my dividend income doing? It is down 1.96%. So that just goes to show you how impactful these 2 cuts have been. They've been pretty impactful on me because they're not the biggest positions, but they're high yielders. And it just goes to show what happens when a high yielder cuts the dividend. A lot can happen. And cash flow for me, it is slightly down year over year. Now, on the second line here with new capital contributions, if you look at my dividend income when I actually reinvested dividends and when I added new capital, and mind you, I add a good amount of capital, but as a percentage of my overall portfolio, it's not tremendous these days because the portfolio is getting a little bit larger. Needless to say, my dividend income, it's up, and it's up 5.46%. And so it's good to see that I am approaching the good life. I'm getting closer to the good life. Even in an environment with a horrible global pandemic, even in an environment where it seems where everywhere you turn, companies are cutting dividends, even in an environment where people think the world is coming to an end, I invest for dividends and cash flow. This is why I do it. Up and to the right. The numbers are moving in the right direction. And yeah, on a baseline basis, I'm slightly down year over year. But because I'm reinvesting dividends, because I'm adding new capital, I'm still getting closer to my goal. And look, I'll probably face another dividend cut or two, but I will weather the storm, and I will weather it even better than before because my focus is moving more towards ultra premium companies. I look at all of my stocks as premium, but I'm moving more and more to the ride or die stocks, which I'll talk about later, and I have talked about at length in many of my recent videos. And so some of the key takeaways from the chart that I'm sharing on the screen right now is continually averaging in makes an impact. Even in a horrible environment, it helps me inch closer and closer to my goal of living that good life. Diversification is key. I do not even want to think about the situation where I had a larger concentration in Royal Dutch Shell or Cedar Fair. I'm very thankful for my diversification. Quality, quality, quality. What I have learned out of all of this, and I am always learning, 20 plus years into this, I am still learning. And one of the things I learned is going forward, it's all about my ride or die stocks for me. And most of these ride or die stocks, they're lower yielders, but those yields in general are very safe in my humble opinion. And so there's kind of a tale of two types of stocks here. You've got the Cedar Fairs of the world that yield a lot more, but the dividend is a little riskier. And you've got the stocks of the world like, say, McDonald's, which is yielding less, but the dividend is relatively safe. Going forward, for me, I am more in the camp of those stocks that have the lower yield, but it is safe. And so that is just the approach that I will focus and hone in on in coming months and years, because I want my portfolio to weather future storms even better than they weathered the current storm. Another takeaway from all of this is increases. They really help. It really, really helps that I observed and experienced increases from companies like Johnson & Johnson and PepsiCo and the Home Depot, because they help counterbalance the dreaded cuts. So you may be thinking, Ian, what are you going to do? Are you going to sell Shell? Are you going to sell Cedar Fair? And I'll tell you, I've always said here in the past, I will never sell. I'm not going to do it. I'm not going to do it. But it gets interesting when you're going through it. You're going through the struggle. You're in the middle of it. And everyone, I'll tell you, dividend investing, it's not easy, and it's hard. And the reason it's hard is a lot of it is the emotional, the psychological side of it. And when I experience these freaking dividend cuts, and I think that both companies, quite frankly, made the right decision, and I would even advise them to do it. Cedar Fair, they can't even open their park. Talk about it more later, but their run rate just to keep things going, even with the parks closed and paring down costs, it's like $30 to $40 million a month. And so we'll talk more about that later. But it emotionally feels a little bit frustrating to experience these dividend cuts firsthand. And then I'm on social media and people tell me, Ian, they cut, just sell it. And I was thinking last week, should I just sell this stuff? Hey, if I didn't have Cedar Fair, it'd simplify my life. No more K1. Put the money in Starbucks. Starbucks is not going to cut the dividend, I don't believe. It's a ride or die company. And I was thinking, and I was like, you know what? Maybe I'll do it. Nope, not going to do it. And I'll tell you why I'm not going to do it. And this is so fundamental. I'll share it on the screen right now. I'll share it right now. Check out this quote. I love this quote. It's from Gene. I don't know if I'm saying his name right, but Fama Jr. He's a Nobel laureate economist, and most of his work actually was around efficient markets and the efficient market hypothesis. A lot of his work led to the mass adoption of index funds because people were believing, hey, you can't beat the market. Market's efficient, this and that. I'll just invest in the market. That part of what he does, I don't subscribe to. I actually do think the markets are generally efficient, say, I don't know, in the long run maybe, but in the short run, I see inefficiencies all the time, and I jump on them, I take advantage of them, I enjoy them, and so I don't agree with my man Gene. Gene, I hope you're watching at home. I don't necessarily agree with everything he says there. But the quote that I'm sharing on the screen right now, I love it. And by the way, so many people attribute Warren Buffett to saying this. Maybe he did say it, but Gene's the one who came up with it, so don't give Buffett the credit. But basically, he says, your money is like soap. The more you handle it, the less you have. And so really what he was trying to say is, look, set it, forget it. If you're in there, you're actively trading this and that, you're probably going to lose out. And so for me, the very reason that I will not sell, and I'm not going to sell Cedar Fair or Royal Dutch Shell no matter how bad things get, is if I sell, my portfolio performance in the long run will probably be worse than if I held on to them. And this has actually been anecdotally my experience in the past. Long time ago, feels like this was I can't even remember when. It was on my top 5 greatest mistakes video. Shout out if you remember that. That was one of my early videos. I'll link to it in the description below. But I talked about BHP Billiton, and basically I bought it. I bought it because someone in the community was talking about it. Never really did my full analysis, and so I bought it. That was the mistake, by the way, is I bought it without being fully convinced and having fully done my own research. That was the epiphany, the lesson from it. But what was interesting is, hey, they cut their dividend. I sold them. I redeployed the money. Funny enough, if you look at that company over the years after, it actually rebounded quite nicely. And so the lesson, there's 2 lessons from BHP Billiton experience. One is that I need to do my own research and I need to follow my own heart. And this is something that's so important if you're at home and you watch this channel. Don't please take notice that I'm not providing any advice here. This is just for fun and entertainment. Stock market is very risky, all that type of stuff. Follow your own heart, your own strategy. And I made the mistake of following someone else. So that was mistake 1. But mistake 2 was, I just sold out of it because I wasn't fully convinced in it. But what's funny is after selling it, like I said, it rebounded. And so what I have kind of I've determined over the years is I now, and this is how I've been operating for a long time now, I pour in the hours into the research when I buy stocks. And once I buy, I shouldn't say never, but I basically never sell. Maybe one day I'll sell something, but these days I always reserve the right. I generally don't sell. I don't sell stocks. And the reason is because of Gene's quote. What I found is the more I kind of handle the portfolio, it's like a bar of soap. Over time, it will erode away. Performance will be worse and worse and worse. And so for me, I want to obviously not have as much emphasis on Royal Dutch Shell and Cedar Fair. What am I going to do going forward? New money. And even dividends. The dividend I get, Royal Dutch Shell still paying a little dividend. I'll take it. I'll put it into companies like Starbucks. That's how I rebalance and get from this to that. That's how I do it. And so for me, I want to stay the course. I'm going to share some bullet points on the screen. I bought these companies for a reason. I thought about selling them, but I decided to stay the course. And I'll prioritize ride or die. I'll prioritize ride or die stocks going forward. But the key epiphany is, hey, I bought them for a reason. And these ones, I know I did. It's not like BHP Billiton. I poured the hours and hours and hours of research, and I'm not going to get scared out of that. I'm not going to let my emotions trick me. Oh, it'd be so easy to sell and put the money in something you like better. No. Over the long term, I know that is going to hurt my performance. And so that's how I look at dividend cuts. Now, what I want to do is I want to look a little bit deeper into what I'm experiencing here with these very dividend cuts. And so I'm going to share some financial analysis on the screen with you all. I want to start today with the Cedar Fair one. And so what I want to share here is a few things. One, I want to share this COVID response. They're going to talk here about what they're doing because of this horrible virus. And basically what the company is saying, this is their press release, is they have suspended the quarterly cash distribution payments. They're going to do that, obviously, because of what is happening with their parks due to the global economy. It's obvious they can't open the parks. But The reason I'm sharing this is so many investors are basing their decisions and their thoughts on what the media says or what the headline says. Read a little deeper. It says they're going to suspend it until they can reinstate it under our recently revised debt covenants. Key words, everyone. Key words. Recently revised debt covenants. That tells you right off the bat. Who knows if they even wanted to suspend the whole thing, but they took on more debt. And when they took on more debt, they gave up their right to pay distributions. This is an MLP, so it's a distribution. I shouldn't call it a dividend. It's a distribution. So I want to share on the screen now more information from Cedar Fair. So check it out. And what you see here is a liquidity and balance sheet update. I pulled this from one of their recent press releases. And what I want to show you here is basically, I'm not going to read all of this, but they pulled some loans. They pulled them at 5.5% interest rate. They're senior secured. Their notes due in 2025. And what was interesting is $463 million off the bat was used to pay down existing debt. So that's money that's already gone. Also, what you see here in the second paragraph, this is so interesting, is it says actually in the last sentence, there is an added requirement to maintain this liquidity, and the company may not make restricted payments such as distributions, generally through December 31st, 2021. So Cedar Fair shareholders, this is a nugget of information you may not know, or unit holders, I should say. We will not be receiving distributions for all of the rest of 2020 and all of 2021, potentially longer. And so the debt that they took on, this $1 billion, has stipulations that distributions are going to be suspended at least through 2021. So that's kind of sad to see, but it's probably a necessary step here. I'm kind of surprised, actually. I personally thought that they'd get back on their feet quicker, but it also seems that they might have taken on a little more debt than they need, and I'll show that next. Before that, though, check out the last paragraph here. It says basically that they are saying their operating expenses, and they can probably lower these in a worst case basis, are $30 to $40 million per month. So keep that nugget of knowledge in mind. And I'm going to share another screenshot on the screen right now, which is an Excel analysis that I just did. Okay, it says new debt is $1 billion. And we know of that, $463 million were used to pay down old debt. How much liquidity, though, is left? Well, what the company is actually telling me on the previous screen out of that press release is right now they have about $821 million of liquidity. And I also know that operating expenses per month on average are $30 to $40 million. Let's say it falls in the middle. It's $35 million. If I take $821 million, I divide by 35, they basically have enough runway now, if you will, to last about 23 months. So Cedar Fair can last in the current environment, if you will, about 23 months. And so taking a step back, what does all of this tell me? One, they cut the dividend, and I think it was a good move given that they can't run their business at all right now. Two, I think it was good that they took on this debt to shore up liquidity. Three, the debt that they took on, they don't keep all of it because some of it was used to pay down an old debt. So they've got about $821 million of liquidity. And with this new debt, it is frustrating, but it comes with a covenant that they are basically not going to be paying distributions to any of us until 2022 at the earliest. So quite some time from now. And then I would say 4, they've got a pretty good runway here. They have enough runway basically to last them, I would say, almost 2 years, because I think they can ratchet down their costs even more. But even at current levels of costs, we've got about 23 months of time. And so do we believe that this park is going to be closed for 23 months? Boy, I sure hope not. If it does, that means bad things for the economy beyond Cedar Fair. Cedar Fair will be the least of my worries at that point. And so, generally speaking, the way I look at this is I feel that Cedar Fair is actually in an okay position. I think this is probably why the stock has been rallying in recent days. I think it is the market is starting to observe that, hey, we're not going to get that juicy distribution for quite some time. But from an actual company standpoint, they're shoring up funds. They're running the company pretty well. Things are going to be okay. And so my takeaway from all of this was one of positivity. It was quite frankly, Ian, you did your research going into this. Investing is like that bar of soap. You don't want to sell here because quite frankly, things aren't so bad. Yeah, the distribution is cut and that's bad. It's awful that I'm not going to see it till 2022 at the earliest. But when I just look at the fundamentals, what it tells me is the Ian of years ago that analyzed the heck out of this thing before buying it. I did my job well. I did my job well because now, even in the middle of a global pandemic, when they can't even operate their business, they're doing all right and they've shored up 23 months of runway. I think that Cedar Fair will make it through this. They'll be fine. They're going to be set back for a really long time because they can't run their business at all. But what it tells me by doing this micro level analysis is the macro level, don't handle the bar of soap too much, analogy rings true. And that's why I look at the micro level stuff. And so while I'm looking at the micro level stuff, with that being said, I want to jump into Royal Dutch Shell and I want to look at the Royal Dutch Shell earnings announcement and some of their fundamentals, because I'll tell you, my hypothesis with Royal Dutch Shell, and one of the reasons I was thinking about selling is I was like, you know what? This company, I bet you, Ian, the balance sheet is just junk. I bet the balance sheet is junk. And when I looked at the balance sheet, it actually wasn't that bad. I was pleasantly surprised, which tells me that the Ian of years ago that analyzed the heck out of this thing before getting into it, again, I did my job. And so check it out. Let's look at the Royal Dutch Shell balance sheet here from their latest quarterly earnings announcement. And so I'm going to put it on the screen right now and check it out. Assets, total assets at this company are $393.9 billion. And if you look at it, most of this assets are property, plants, and equipment. That's, I would say, of real value. They have also a bunch of cash. They have almost $22 billion worth of cash. And so I would say in general that this company, from an assets side of things, they're pretty strong. I feel good about the assets side of their balance sheet. Let's look really quick at the liabilities side of the balance sheet. Let's look at that. And so when I pull it up on the screen, you can see in terms of liabilities, they have $210 billion worth of liabilities. And so that's pretty darn strong, and it leaves them with equity, shareholders' equity of almost 180 or more than 183 billion. This is a company right here that, yeah, they got a lot of debt, and you can see it on the liabilities. It's almost 80 billion worth of debt. They made a big acquisition a number of years ago that I was concerned about at the time. I'm still a bit concerned because they took on debt in a tough environment for oil companies. Nonetheless, they did it. This was during the last oil crash, and now we have another one. So not so much later, so soon, too soon, if you will. But they got some debt. But the way I look at it is 80 billion in the scheme of things, and that's non-current liabilities. Current, they got another almost $16 billion worth of debt. But when I look at this, the debt in comparison to the assets, it ain't so bad. And the equity, the shareholders' equity is a strong $183 billion. And so again, the reason I do the micro level analysis is it's just fun. It's another way of kind of back testing, if you will, what I did all those years previously. And even in this horrible environment, where they had to cut the dividend. Balance sheet looks pretty good. Balance sheet for Royal Dutch Shell looks good. I'm not selling it. I'm not doing it. I feel that their balance sheet is good. And so while we're at it, I want to share some more stuff with Royal Dutch Shell. So I'm going to pull up on the screen their income statement. And so let's just look at that really quick. Let's see, how did they do in the quarter that they just announced? I think this was a very interesting earnings release. And you can see here on their income statement that basically they did a total revenue and other income in Q1 2020 of $61 billion. And you can see how that is down substantially from $85.6 billion in the comparable quarter a year ago. You can see that the total expenditure from the company was $60 billion, where it was $76 billion in the same quarter a year ago. And so you can see that basically they are breaking even, if you will. They are the income or loss attributable to the Royal Dutch Shell shareholders. They lost $24 million in Q1 2020 versus making $6 billion in the comparable quarter a year ago. And so, look, things are going to get worse. Things are going to get worse for Q2. But what I look at, what I like seeing here in Q1 at least, is look, they're breaking even. And so they are breaking even in a horrible, horrible environment. Balance sheet is fine. They're going to weather this storm. Am I adding more? No, it's not my focus going forward. Am I going to sell? Absolutely not. Not going to do it. My micro level analysis shows me that it is a premium company still. They're not at fault for what's going on with the price of oil. They're an oil super major dealing with the cards that are dealt to them. And I think they're weathering the storm and they're dealing with these cards pretty darn well. And so I want to share more stuff on the screen with you right now. I have a few more things to go through. And what you can see on the next screen is just a summary of what's going on right now with Royal Dutch Shell from a dividend cut standpoint. And so the price per share is $33.91. The old dividend was 80 cents a quarter. New one is 27 cents. And so they basically cut the dividend by 66%. Thankfully, they didn't eliminate it. They still have something, but they cut it substantially. And so basically, the new dividend yield is a 3.21%, and that's on the current share price of $33.91. And so it's not a very exciting dividend right now, but it's something. And so I feel like they made... Hey, I'm just glad that they're still giving the shareholders something. And I think it's probably wise and prudent that they did suspend or cut the dividend here. They did that cut because of what's happening with the price of oil. I would not be surprised if going forward, the dividend were brought back up to higher levels in the future once the price of oil resolves itself and once the company gets fully back on its feet. And so, worth noting here, I looked at the EPS estimates as well. In 2020, based on the current share price, it's trading at a 21 PE based on the earnings estimate of $1.56. 2021, it's really hard to forecast 2021, but I bet the analysts are using some reasonable assumptions for a bounce back, if you will, in the price of oil. Correction on the way up brings the PE down to a 13, basically. And so, basically, what I learned out of all of this is Shell right now, I'm not going to be buying any more Royal Dutch Shell, but where it's trading right now, I don't think it's overvalued, that's for sure. I think it's fairly priced, if not undervalued, as compared to a lot of other companies out there. It's trading at a reasonable discount, if you will. And now there's some risk because we don't know what's going to happen with the price of oil, but I'm sure it will go back up to normal sooner or later. And so what the PE metrics tell me is on a current year, and even on even just put aside the next year, just look at the current year. This thing, it's trading at a PE, quite frankly, that is lower than a lot of the premium stocks I own, the ride or die stocks, which I'll talk about later. And so it's exciting, it's interesting to see that. Anyways, that's Royal Dutch Shell. So the third company I want to go into a little, this isn't as much of a micro level analysis, but I want to look at it a bit. Is Disney. And so By the way, actually, before I get to Disney, going back to Shell, I'm gonna pop this on the screen one more time, and so hang in there with me. Long video today, a lot of good stuff to go through. The dividend that they are paying right now is $1.09 per year. The old one was $3.20. You can see the reason they brought it down is the analysts expect them to earn $1.56 this year. If they earn $1.56, they can support a dividend of $1.09. They cannot support a dividend of $3.20. Analysts expect them next year to earn $2.61. $2.61 still cannot sustain a dividend of $3.20. And so what this tells me is to get to the full dividend that we had, it may be a few years out. It may be a while because the earnings, quite frankly, just don't sustain it. But they do sustain the new lower dividend level. So I think they took prudent action. They're playing the cards that they were dealt. Anyways, I want to talk about Disney. My kids own Disney. I've talked about this before. I guess Abigail Disney, the granddaughter to Roy Disney, she doesn't work at the company, but she was mentioning in social media, hey, you guys should cut the dividend. Well, they did. So she got her way. I did a video on that. I'll link in the description below. Let's look at it. Should Disney have cut their dividend? What do I think about Disney? Let's take a look. So I want to share on the screen right now. I'm going to start with the dividend cut. So you can see that basically they said, hey, we're going to cut the dividend. 88 cents per share, their semi-annual dividend. They're going to do this to basically save $1.6 billion. And so it's going to save some money. I think that Disney got pressured into doing this for political reasons. I spoke about this in my last video. The question I want to answer here in the video very quickly without going into too much depth, did they really even need to cut this thing, or did they do it just to appease people out there with loud voices in social media and such? And so let's look at it. And so on the next screen, I'm just looking really quickly at their earnings. And what the earnings show is that their earnings dropped pretty substantially. They decreased 93% to 26 cents. And that was, though, just on a GAAP basis. On a non-GAAP basis, they basically decreased 63% to 60 cents from 161 in the prior quarter a year ago. And basically, they said EPS from continuing operations was $1.44 for those 6 months. And it was $2.14 if you exclude certain items. This is really important. This is really important because what did I just talk about with Shell? The reason Shell cut the dividend, and they had to, is because the EPS doesn't cover the dividend. Why did Cedar Fair cut the dividend or the distribution? Well, one, because they took on all this debt, and the company or the entity they took the debt from said, hey, you ain't paying distributions at least until 2022. And they had to because they can't even operate their business in this madness that we're living through right now. Disney, Abigail Disney, I look at the numbers. Okay, on a GAAP basis, they last 6 months they earn $1.44. Non-GAAP basis, $2.14. We know from the prior screenshot, 88 cents is the dividend. Does $1.44 cover 88 cents? Yes. Does $2.14 cover 88 cents? Yes. Does Disney have the money to pay the dividend? Yes, they do. And so why did they cut the dividend? In my humble opinion, it's all about my last video. They fell into the pressure. And so, look, my kids are long-term shareholders. They got a lot of time on their side. I knew that Disney, the reason people ask me, Ian, why don't you own Disney in your own portfolio? Well, one, I kind of look at things holistically, and as a family, I guess we've got exposure to it. But I also look at it that my lifespan is not long enough to get the benefits of owning Disney. Disney, I look at as ultra long term, and I think there's a lot of opportunity ultra long term, but the long term is so long that it's not for me. That's why I don't own it. And so But like I said, kids don't need the dividend now, but it's kind of frustrating to see this because in my opinion, companies exist because of the shareholders. The shareholders were the ones that invest. We're the owners. We gave the money to the company to build the company. The people who work at the company, the managers, they work for us. The board of directors, they work for us. We hire the board. And of course, the board owns shares too. And some of the people that work at the company, they own the shares. Hey, I encourage that. Everyone should have skin in the game. I think that's good. What I'm saying is ultimately, if a dividend can be paid and the company financially has the means to pay the dividend, and certainly don't pay the dividend if it's going to hurt the company, and the company is making wise decisions, pay the dividend. And so the fact that Disney is not paying the dividend, I think it's flat out a mistake. I do. I think it hurts dividend investors, the very shareholders that trust these companies with their money. I hope it is a trend that does not continue because it does seem to be getting some steam in social media, as I shared in my last video. And so with all of that, let's move on. Let's talk about Starbucks. So I bought some Starbucks stock last week. I bought it on Monday. I bought it on Monday because I wanted to start my week on a positive note. And I love this. I love Starbucks. I love that I can go there again and get my beverage. It's so funny. We were talking about PEs. We're talking about valuations. And historically, I've kind of looked at Starbucks as, especially in this market, it looks like it's vastly overvalued. Check it out on the screen. I bought shares at 71 and change, and at a 2020 estimated EPS of $1.37, it's now trading at a PE of 52. Ian, why are you buying Starbucks at a PE of 52? Well, I did some modeling here. Let's look at it. Well, one, when things get back to normal in 2021, PE will be down to a 25 and change. Not so bad, but still kind of high. But check this out. Dividend yield, starting yield, it's not so high. It's at 2.3%. But the 5-year compound annual growth rate of the dividend is a 20.7%. Staggering. These guys raise the dividend on average each year by 20%. And mind you, it will probably go down. It will probably decrease, especially during these global pandemics. But let's just look at this for a minute. Let's look that, hey, over 5 years' time, if the dividend keeps growing at the same rate, yield on cost will be 5.88%. Let's just assume it can do it over 10 years. If they increase the dividend as they have for the last 5 years by 20% per year, if they can keep doing that for 10 years in the future, my yield on cost in 10 years will be a 15. It'll be 15%. And so the reason that I'm investing in Starbucks right now is, you may think it's crazy. Ian, you just said Disney, you don't do it for yourself because your timeline is not long enough. And you know my timeline is so long. You know it, those that have been around here. Starbucks, it's one of these things where it seems deceptive. It's like, hey, PE in the current year is so high, starting yield is so low. But what I think so many people get wrong with Starbucks is the company is going to continue to grow very fast. It is tech-like growth because, quite frankly, they are a tech company in many ways. With their mobile app, it is one of the largest and by volume payment processors in the world. They are a tech company. And I think, quite frankly, this horrible pandemic, it is skewing them to be even more of a tech company. And so what so many people get wrong with Starbucks is they're deceived by the high PE, they're deceived by the low starting yield, but they don't factor in the appropriate growth. And the growth will come in earnings and dividends, and yield on cost with this company is a real opportunity. There's real potential for opportunity for this one. And this is why, quite frankly, tomorrow morning, Monday, I will probably buy more. And I'm probably going to make this an ongoing thing for the next few weeks. Maybe I'll just buy it every Monday just to try to start off the week on a good note. I got a lot of love for Starbucks and I want to build it to be a much bigger position. And so that's Starbucks. I want to move on to the next segment of the video today, OTIS. And so a lot of people were wondering, Ian, back in 2019, you were buying a lot of United Technologies stock. You were doing it ahead of the big events that were coming up. And the events where they were going to spin off Carrier and OTIS, and then they were going to simultaneously merge with Raytheon, creating Raytheon Technologies, which I own right now. People are wondering, Ian, you going to hold on to Carrier and Otis? And yes, I am. And it goes back to the analogy of the soap. I'm not going to handle the soap because if I handle the soap, my returns over the long run will be subpar. And so I'm going to share it on the screen right now. What is so exciting about Otis is they just announced a dividend. And so it's trading at $52.95. And on a PE basis, quite frankly, it's richly valued. It's the current PE is a 27, 2021 is a 24. The dividend per quarter that was announced is 20 cents per quarter. On an annual basis, that is 80 cents. And so starting yield is 1.51%. Quite frankly, I am glad I held. And yeah, it's a low starting yield, but it will only increase over time. And so I'm really excited to see that from Otis, and I just feel so blessed to have held on to this, sticked with it, because I'll tell you, when I see these small positions in the portfolio, they're distracting. When I have positions like Royal Dutch Shell, I feel a little compelled. Should I sell it and put the money in Starbucks? No. I'm glad that I am sticking to the plan and I'm having the willpower to do so. And so with that, let's look at the ride or die stocks. It's been a while since I've done this, so I'm going to share it on the screen right now. I want to look through my ride or die stocks, and those who have been here a while know these are my favorite stocks of all time. These are the most premium dividend stocks that I can come up with, and these are the ones where I'm putting all of my money right now. Generally speaking, with ride or die stocks, I'm reinvesting dividends. Generally speaking, with most of my other stocks, I'm not, and I'm taking the dividends from the other stocks and selectively reinvesting them into ride or die. Now, there are some exceptions. Companies like Otis, it's kind of small, so I'm reinvesting dividends. But in general, most of my non-ride or die, I'm not. And so with these companies, I highlight the ones that are of interest to me. And one of the ones that's of interest right now is J&J. On a 2021 PE, they're forecasted to be at a 16. And so out of the stocks on this list, I would say J&J right now, it's still at $148, in my humble opinion, still a reasonable value. I'll probably be buying more. Pepsi, PE is high, but the yield, it's a 3%. And so I feel like Pepsi, I could see myself buying some Pepsi here. Look, I don't want to fool myself. I'm not buying discount here, but I'm just saying, even within the list of ride or die, even in a market that is richly valued for premium companies, I feel okay buying these ones that are highlighted. Let's look at Duke Energy, starting yield of 4.62%, 2020 PE of 15, 2021 in the 14s or almost 15, high 14s. Good value. Coca-Cola, starting yield of 3.56. Look, the PE is not great, but the yield is, and I know that the dividend at Coca-Cola is not going to be cut, in my humble opinion. 3M, I still love 3M. I'll probably be buying more. Close to a 4% yield, PE at an 18 in 2020, 16 in 2021. Still a value, even though it's rebounded. Kimberly-Clark, 3% starting yield, 18 PE, 17 or high 17s when you get to 2021. What I'm trying to say here, Realty Income, by the way, 5% dividend yield, not bad. And it's trading in those 50s, not bad. I probably should have highlighted Realty Income as well. What I'm trying to say here is I feel optimistic these days. Maybe market will go down again. If it does, I will average in quite aggressively. But even at current prices, I'm happy to average in small bite-sized chunks to get closer and closer and closer to my goal, so that even if I experience another dividend cut during this horrible pandemic, I will be constantly reinvesting dividends, constantly deploying more capital, and experiencing increases in certain cases, like I did with Pepsi, that I will inch closer and closer and closer to my goal of living the good life with full financial freedom from dividend stocks. So that's my ride or die update. Share in the comments below. Are you guys buying right now? How are you looking at it? I'd be really curious. All right, so long video today. I want to get to the final topic, which is PepsiCo. I'm going to share it on the screen right now. I want to share with all of you how Pepsi just increased their dividend. And so I also have some interesting financial analysis to share here. By the way, my first tranche, it was bought in 2011. I bought it 63 and change. It's now at 134. Just goes to show Dividend investing, dividend stocks, they can show capital appreciation as well. And so I'm up 110% on the first tranche. And a lot of people think you have to invest in tech stocks or you have to invest in stocks like Starbucks to experience capital appreciation. No, stocks like Pepsi, you can get it there too over very long periods of time. 2020 EPS estimate is $5 and change. 2020 PE is a 25. 2021 PE is a 22. Dividend yield 3%. One of the things I want to share here that I haven't done here for a while that I find so interesting are these metrics at the bottom called PE on cost. Say I take my first tranche purchase price of 63 and I divide it by the 2020 EPS estimate, which is 534. My 2020 PE on cost is a 11.94. Say I take my first tranche purchase price of 63 and change and I divide by the 2021 estimated EPS of 589. My 2021 PE on cost is 10.83. And my yield on cost, simple yield on cost for first tranche is 6.41. What I'm trying to show is an interesting progression of time. When you own quality dividend stocks over long periods of time and earnings grow over time, there's not only a notion of yield on cost, but there's a notion of PE on cost. And what PE on cost shows is how little risk I now have on my first tranche of PepsiCo, because I'm literally, now I own Pepsi at PEs in the 10s and 11s. And so it's so exciting to look at that metric. Just another different way of looking at things from a dividend investing standpoint, long-term dividend growth investing standpoint. All right, everyone, I hope you enjoyed the video today. Thank you for hanging in there. I know this video is a little late, but I want to make sure to put out my best content. And I was busy this weekend with throwing a fabulous Mother's Day celebration today. We enjoyed Mother's Day celebration as a family, a lot of fun. And so spending time with the family today, filming video tonight, probably editing video a little bit later tonight, working hard on the hustle with the goal of living that good life like Kanye and T-Pain. And so before I leave today, in terms of full disclosure, I own the stocks mentioned today. And so in terms of full disclosure, I am long Cedar Fair, ticker symbol FUN, Royal Dutch Shell, ticker symbol RDS-A, OTIS, ticker symbol OTIS, Carrier, ticker symbol CARR, StarBucks, ticker symbol SBUX. I am also long all of these ride or die stocks. Johnson & Johnson, ticker symbol J&J. PepsiCo, ticker symbol PEP. McDonald's, ticker symbol MCD. Clorox, ticker symbol CLX. Duke Energy, ticker symbol DUK. Procter & Gamble, ticker symbol PG. Coca-Cola, ticker symbol KO. 3M, ticker symbol MMM. Kimberly-Clark, ticker symbol KMB. Starbucks, ticker symbol SBUX. Home Depot, ticker symbol HG. And Realty Income, ticker symbol O. I own all of those stocks in my personal dividend stock portfolio. Also, before I leave today, just in terms of a disclaimer, I'm not a licensed financial advisor. Today's video is not financial advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my opinion here on YouTube for fun and entertainment. Just sharing my personal journey. Stock market carries great risk. All right, everyone, I am tired. That's it for the video today. If you enjoyed it, please subscribe, like, comment. All of that means the world to me. I love you all. I will see you in the next dividend investing video.